All right, we're here again, and in this attempt to solve this question one, like I mentioned earlier, we'll be starting with the statement of profit or loss and other comprehensive income for the year ended 31st May 2020, 20x3 for Apapa PLC. Remember, I told you that this is the requirements, this is the first requirement of the examiner, and the examiner here is asking us to prepare the separate financial statements of Apapa PLC. The purpose of the separate financial statements here is to learn how to adjust for omissions and commissions in the separate financial statements in line with the relevant IAS. And in this case, we are adjusting for the parent's omission of the sales proceeds from the disposal of 40 million shares in the subsidiary. We are also expected to account for the profits and related income tax expense arising from the transaction. This question one on Apapa PLC and WAF PLC actually test IAS 27, IFRS 10, and IFRS 3 in addition to other international financial reporting standards. So let's quickly go into the statement of profit or loss and other comprehensive income. Like I said, I'm trying to show you my screen so that you can see exactly what I'm talking about in real time. So I will also make sure that I use my mouse so that in case you need to make reference to what we are doing, it will be clear to you. Now let us quickly look at the first line item, which is profit before gain on disposal of shares in subsidiary. Here we have a profit before gain on disposal of shares in subsidiary of 130 million naira, and this amount is quoted just because we received it, or we saw it in the statement of profit or loss and other comprehensive income of Apapa PLC, and I'm referring to this. So this is the figure for those of us who are looking at their screen right now. Then we move to the need to account for gain on shares or equity disposed by Apapa PLC. To calculate this gain on shares or equity shares disposed by Apapa PLC, we need to first remember that we need to calculate what we call disposal of shares or equity shares in subsidiary. Let us now establish two key facts. Fact number one is that from March 1, 2023 to May 31st, 2023 is a period of 3 months. So let's calculate it together. We have March, we have April, we have May. So between March 1st, 20x3 and May 31st, 20x3 is a period of 3 months. And within these 3 months, the NCI or non-controlling interest is 35%, and while the parent entity has 65%. The period before March 1st, 2023 is a period of 9 months, and within this 9 month period, NCI is 15%, while the parent entity, that is Apapa PLC, has 85% interest in WAF PLC. We were told that 40 million shares were sold for 160 million naira. Therefore, if that is the case, then let us prorate 40 million shares out of 200 million shares. Where did we get the 200 million shares? You remember that at the very beginning when we read this question, I told you that the equity share capital of WAF PLC was valued at 200 million naira. And this 200 million naira worth of shares is valued at each, or each of those shares is valued at 1 naira each. So what that means is that to know the number of shares in issue in WAF PLC, all we need to do is say 200 million divided by 1 naira per share. And that will give us 200 million shares, 200 million equity shares. When we know that amount, or when we know the number of shares, then we can safely say that Apapa PLC disposed 40 million out of 200 million shares in WAF PLC. And what that means is this: 40 divided by 200 million will give us 20%. Let's try that on our own. 40 divided by 200 is 1 over 5. 1 over 5 multiplied by 100% is 20%. Therefore, we can now go ahead to calculate the next step. In the next step, we are going to be looking at the disposal proceeds of 160 million, and then we less the original cost of the equity shares acquired in WAF PLC. Remember that we're told that 85% was acquired for 255 million. Therefore, the 20% disposed is equal to X. Hence, we have two equations here. The first equation is that 85% is equal to 255 million, and 20% is equal to X. Now, the question is find X. To find X, what we need to do is to simply cross multiply 85% by X. So when you cross multiply 85% by X, we have that is equal to 255 million multiplied by 20. Therefore, X will be equal to 255 million multiplied by 20 divided by 85 million, 85%. When you do that, the original cost of the equity acquired in WAF PLC is 60 million. Therefore, when you subtract 60 million from the sales proceed of 160 million, the parent gain on disposal of those equity shares is 100 million. Let us stop there for a while. But before then, let's note that we need to account for corporate income tax on this gain, which is 30% as stipulated in the question. Some people may be wondering where we are looking at right now. So let's go back to the question and let's see how we can trace it again from the beginning. We're told that income tax is 30%. So, in the absence of this information, we would have just found a way to use the prevailing rate in Nigeria. But since the examiner is specific that gain as calculated in the parent's separate financial statement will be subject to corporate income tax of 30%, then all we need to do is to use the 30% given in the question. When you subtract 30% of 100 million, we are going to be left with 30%. And then 30, we are going to be left with 30 million. Therefore, 100 million minus 30 million will give us 70 million post income tax expense deduction from the parent's gain on disposal of equity shares in WAF PLC, which is the parent's subsidiary. Therefore, this parent's gain of 100 million will be added back to profit before tax of the parent in the parent's separate financial statements. Now, I try to break this down because at some point you are going to be seeing the final solution that I've been talking about, or from where I've been speaking. So let's quickly look at what we need to know. The next step is to account for profit before tax. Remember that the existing profit before tax was 130 million, and we've now added 100 million to that. So 130 million plus 100 million will give us 230 million, and we need to less the income tax expense. So let's now do the workings for income tax expense. The existing income tax expense in the statement of profit or loss given for Apapa PLC is as follows. We have 40 million. This 40 million is the income tax expense of Apapa PLC, which is a separate economic entity. So we are not interested in the INWAF PLC's income tax expense right now. That will now take us to the next line item, which is to account for the additional income tax expense. An additional income tax expense is 30 million. Remember, I told you that in the question, the examiner has already given you the income tax expense rate. So we call that the CIT, or the company's income tax expense rate of 30%. So what that eventually implies for us is that 30 million arising from tax liability due to disposal of equity shares in subsidiary during the period that was omitted earlier on, that we have now reinstated or recognized in the financial statements, would now imply that we do one thing. We have to add 30 million back to this 40 million here, and that will give us a cumulative income tax expense of 70 million naira. That is very simple, and that is all the examiner needs from us right now. When you subtract 70 million from 230 million, the resulting figure is 160 million, and that 160 million is the profit for the year. Now we move to the other comprehensive income. The other comprehensive income net of tax is 20 million, and we got that from here, right? So we are still looking at Apapa PLC, because the first step in this question is to prepare a revised financial statement for Apapa PLC. Two financial statements were noted specifically by the examiner. The first, which is the statement of profit or loss, and the second, which is the statement of changes in equity. And to do that, we have already established the protocols. So when we add 20 million other comprehensive income net of tax plus 160 million, we have 180 million total comprehensive income for the year. Now, what this implies is that we have now come to the end of the parent entity's separate financial statements, that is the statement of profit or loss and other comprehensive income for the year ended 31st May 2023. And I'll just take out some time to show us that, so that we can appreciate how we got to this point and we can know the next step to take. So I will just show us a little bit of it, of what I've said so far, and make sure that